Hello traders, so in this mini course, we're going to explain everything you need to know about a candle in regards of price action. Well, let's talk about the basics of a candlestick. So this is a bullish candle. So you have your price open right here since this is the bullish candle. So this is your open, this is your close, this is your candle low, and this is your candle high. So let's say this is a daily time frame. And let's say you go on the 1 hour, and how would this candle look on the 1 hour? So how this candle would look on the 1 hour would be, you would have your open right here. You would have your candle low right here. You would have your candle high right here. And you would have your candle close right here. Same thing. Open, low, low, high, high, and candle close. So same thing for a bearish candle. When it comes to your bearish candle, this will be the candle open, this will be the candle high, this will be the candle close, and this will be the candle low. So again, it doesn't have to be specifically a daily candle since price is fractal. It could be let's say this is a 1 hour candle, and what we're gonna interpret here will be on the 1 minute. So let's say this is the 1 hour, and this would be the 1 minute. Price starts off. This will be your candle open. This will be your candle high. This will be the body, which is the range. Price makes a candle low. And this is the candle close. So candle close, candle low, candle high, candle open. So now that you understand how a candle would look on the micro time frames, understand that the range is determined. If it's a bearish candle like what you see right now, the range would be from your candle close all the way to the candle high. And if this was a bullish candle, your range would be the candle close to the candle low. And the range would be a discounted area and a premium area. So to explain your zones real quick, which we already did in multiple different lessons, let's just keep it quick. This would be your premium area, and this would be your discounted area. Now, again, you can break this into extreme discount and extreme premium by breaking those halves in half. So now you have your top quarter. This would be your extreme premium. Now you have your bottom quarter, which would be your extreme discount. Now let's break it down to the lower time frames. How would your range look? You would have your premium level right here, your premium zone, and you would have your discounted zone. And now you can break this zone into extremes. This would be your top extreme. This would be your bottom extreme. And again, this will all make sense as we continue with this course. Before you proceed, please make sure you like the video and leave a comment. This will help us continue making these free lessons. But before we get into that, let's take a quick detour on candle flips and how a candle is formed. You have a bullish candle. This candle starts off as a bullish candle. So let's say this is a daily time frame and the first 3 to 4 hours are bullish. And now this would be your candle open. So this is where the candle opens. So your first 3 to 4 hours are bullish. Now the candle comes back and you would think the candle is turning bearish. And how do you know that? That's when price gets below the candle open. So what would happen to the distance that the candle traveled already? It would turn into a wick. So now price continues below, and now you have a bearish candle. So this is your candle flip. Understand, the candle is made from accumulation, manipulation, distribution. These are your 3 cycles. And a lot of times the accumulation happens during your candle open. The manipulation would be the fake out to induce traders into taking the wrong position, and the candle will flip on them. This is your candle flip theory. So now let's look at a bullish example. Your candle started off bearish. This is your candle open. Now the candle is turning. When the candle turns, that range traveled is a wick. And now the candle completely flips to a bullish candle. So here's an example of a candle flip. So this is your current candle close. So if this is your Candle close, that means this is the next candle's open. Common sense, right? So this would be your candle open. So now let's go on the micro. And let's play this candle out. And now the candle close. So this was the candle open, candle high, candle low, candle close. Now let's go on the daily. So this was your candle. Now let's mark it. This was your candle close. This was your candle low. And this was your candle high. And again, if you want to look at it from a candle flip perspective, what you want to do is you go on the 1 hour. Here you have your accumulation. Here you have your manipulation, which was your candle high. And here you have your distribution. So there's two ways to determine the direction of your candle flip. There is your historic reference and there is your immediate reference. So now let's talk about the immediate reference. The immediate reference is all about the previous candle. So your reference candle is your previous candle. So if you're waiting for this candle to flip, you're going based off the evidence that you have in this candle. And how would this look on the lower time frames? This will be your candle open. Your basic support and resistance structure. So here's an example of a bearish flip continuation. So how this would look on the lower time frames will be your opening right here, your wick, low of the day, candle close, wick, drop, low of the day, and candle close. So here you have your reversal candle flip. Instead of a continuation, you have a reversal. And this usually happens based off historic reference. So how would this look on your micro? So here you have your candle open, your candle makes a high, drops down, makes a low, consolidates again, drops back, and again, you see how fractal the market is? Again, you have what happens in a continuation on the micro happens on the macro, just in a different context. You have your accumulation, manipulation, and distribution. So let's take a look at this example. So what do you see here? You see the price is clearly in a downtrend, but you can see the price is going through a retracement. So what you want to do is you want to pull out your fib to get your historic reference. So now that you understand that the trend is bearish on the macro, but price is currently going through a retracement, and what you could expect is price reversing from this level to continue down, or price reversing from this level and continuing down. And we know the probable level here is your extreme premium. So what we do is we mark up our premium. Now that you have your premium marked, mark your candle high, Why would we mark our candle high? Because this will be the next candle's opening. So now we can go on the 1 hour. And if we know that we are currently in a pullback, and we know the grand scheme of things is this is a retracement to continue bearish, we're looking for a bearish candle flip. So this could happen in this candle or the next candle, the candle after that, but we are looking for a candle flip. So what happened here? Let's slow down. Price attacked the macro extreme premium. So we can kind of make an assumption that price will reverse, but can you make any concrete decision yet? Not really. Why? Because all you have now is your accumulation and you have your manipulation. Price did not start the distribution cycle yet. So what you would wait for is you would wait for price to come back inside of your candle open, right? Because if price comes back inside of your candle open, that means that the candle is turning. So the candle is turning from a bullish candle into a bearish candle. And once price crosses this line, you can confirm the flip is happening. So now once price came inside of this candle open, now you can clearly start looking for bearish setups. Why? Because now the candle is in your favor. Now you anticipated the candle flip and this is close to the candle high. So now you have a huge range to take advantage of. And if we go on a daily time frame, this is how the candle looks. And like we said previously, when you have a reversal as far as your candle flip goes, a lot of times it happens based off historic reference. So it has nothing to do with the previous candle, but it has something to do with the overall range. So before we start looking at immediate reference, we need to understand what we are looking for. What specifically are we looking for in the previous candle? And what we're going to look for is our PD arrays. And the first PD array would be the bottom of the shelf, which some people call, a lot of smart money people call breakers. So the bottom of your shelf would be your first PD array. The second PD array would be anything in the middle of your premium and discount, which would be your fair price. So a lot of times in fair price, you can find an order block, you can find a fair value gap, you can find a high rejection level. So whatever is in the middle. So in this case specifically, you have a order block in the middle of the range. Now, what is your next PD array? It would be an extreme supply or demand, which in this case, it would be a supply, and that would be your bearish order block, your extreme bearish order block. And last but not least, you have your liquidity. So price could reject from any of these levels. Price could reject from the first one, second one, third one, or price could go all the way up to the top of the previous candle, which would be your candle high, and take that liquidity before reversing. And in this case, price rejected from your bottom of your shelf, which is your breaker or mitigation block or whatever smart money traders call it. And what you want to take into account is you always want to make sure you're assessing the range. You have your premium and you have your discount. So if you're looking to take your trading to the next level, make sure you enroll in our bundle package. You got 41 lessons where we cover everything you need to become a successful trader. So let's take a look at this example. So what do we have as far as our historic context? We have price coming from an extreme zone. So let's say this was our extreme demand, and price is rejecting from this level in a overall bullish trend. And our target level would be this liquidity. So we can say that price is attracted to this level. I don't know if I can find a magnet right now, and this might take too long. Yeah, this might take too long. So let's say price is attracted to this level. This is the level of liquidity, and this level will act as a magnet. So price wants to be pulled to this level right here. So my next step is looking at my candle flip. So this is the candle close. So what does that mean if it's a candle close? That means this would be the next candle's open. So now I can go on my micro, my 1 hour, and I can start looking for my levels. So let me remove this to avoid confusion. So what do I have here? What PD arrays do I have here? My first PD array needs to be in my premium zone. So if I was to pull out my fib right here, low to high, my first level needs to be right here, which would be the breaker, which is the top of your shelf. So this will be my first level. Mark this entire shelf. What would be my second level? My second level would be fair price. And what would be the third level would be an extreme level rejection, which in this case we have a order block right here, but it's not all the way in extreme, but this is as far as it go without going to this mitigated order block as far as a even lower time frame goes. So now I can remove my fib. And once I remove my fib, I have these three levels. So what am I waiting for? I'm waiting for a rejection from one level and a flip. And obviously you can be more precise. You can specifically target one level. And if you want to target one level, so let's say every time you're looking for a candle flip, you're looking for a specific level, you need to do your research. You need to collect data and understand. In this case, this is gold. Analyze when you're looking for a candle flip, what is more than likely to work? And this is when you go through your back testing and collect data and see, okay, gold usually reverses at this PD array. And then you mark that up and then tally how many times price reverses from this specific PDA compared to this one, and always go for the highest probability. That's how trading works. So price is finding rejection. So let's see if price gets above this level, which would be the candle open. And price got above the candle open. So what can you say now? Now you can say the candle completely flipped, and now you have a clean bias to the upside. Did the candle close yet? And the candle closed. So you had a bullish candle. So now if we go on the daily, you had your bullish candle flip. So let's take a look at this example. So the first thing you want to do is you want to look at your historic reference and where's price coming from and where price is heading. So what I see here is price is rejecting. Price is rejecting of this extreme level. Obviously, this is the extreme between this low and this high, and price is rejecting from this level currently. But prior to this, price rejected from the opposite extreme. So what context do I have right now? Is that price is stuck between an internal to an internal. So price is rejecting internal, 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 until price finds enough buyers or sellers to break this range. So now that we understand this, we understand that we are bullish. So your next step is to locate your candle and mark up the candle close. Why mark up the candle close? Because like we said for the past 15-20 minutes, that you're looking for a candle flip, and this candle's closes, the next candle's open. So now you go on your micro, which is your 1 hour. And what are we looking for now? We're looking for a PD array. Now, what makes this example interesting is if you look to the left here, all your PD arrays have been mitigated. You had a PD array right here, this extreme level mitigated. You had an extreme level right here mitigated, and you had your fair value gap in fair price, and price is already at that level. So you really have limited options. But in a unique case, this is actually one of the best situations to be in, because let's say you have a multiple choice and you got options from A to C. In this case, only C is left. And C in this case would be, you have a stop hunt right here. Now that this stop hunt happened, you're looking for a return to origin before a candle flip. So what you would want to do is you would want to mark this level. You would want to mark this level, and what you're waiting for now is waiting for price to reject from this level and flip and come back to the candle open. Once price comes back to the candle open, you can confirm that this is a candle flip. Now price reached this level, you can confirm that the candle is flipping and you can start looking for bullish setups. Hope you guys enjoyed this lesson. Please make sure you like, share, and subscribe, and leave a comment below what lesson do you guys want next.